Okay, hi, my name is Lesley Batson, and I am the Chief Chick at Rebel Rock Wealth. And I recently published a podcast episode, number 9. It's called The Best Place to Store Cash. And I got some questions, really because it's information that most people have never heard before. But I thought that this would be easier to demonstrate in a video versus a podcast, just so that you can kind of see the numbers and follow the numbers. And it just really helps to illustrate the point that I was making. So first of all, if you can go back to episode 8. This was a 2-part series. So episode 8 was just talking about the difference between savings and investing, and why savings is important, and that it's really the first critical step of your wealth building journey. And then episode 9, the one that's called Best Place to Store Cash, was really walking through using a whole life policy, a high cash value dividend paying whole life policy as your savings, and all the benefits around doing that. So I wanted to just demonstrate in this video what I was talking about, okay, just so that you can kind of just see the numbers for yourself. So I just am using some numbers from a policy that I recently provided to a client. And she's 35 years old, so her current age is 35 years old. And what we're doing here is just projecting her age out to 95. So this is just saying, if she were to live to be 95 years old, this is what her cash value account would grow to be. So it's showing an internal rate of return of 4.6%. So this is the equivalent of earning 4.6% every year for 60 years, okay? In her scenario, what she's doing is paying, she's putting away $25,000 a year. Her premiums start at $25,000. You can see that they change, they go down over time, and it's just because essentially some riders are expiring at different ages. But just understand that these are the cash flows that she's doing. These are the premiums that she's putting in each year. Her face value is starting at $1.7 million, and at the end of at the end of age 95, you see that her cash value is $7.4 million. It has grown at the rate equivalent to 4.6% each year for 60 years, and it is now 7.4 million, and her death benefit is 8.2 million. So I'm going to just record that here. 7,453,340, and her death benefit is $8,201,759. All right. So again, her rate of return here is the equivalent of 4.6% each year for 60 years. What I'm going to do here is copy this and paste it into this field here. So as we walk through this, you'll see in a minute, when I'm showing you these numbers here on the right side, it's going to be using this rate, okay? So just to show you that it's equivalent, if I were to select alternate account, which an alternate account is like a savings account, it could be a money market account, could be a CD, but it's really where you may be thinking of today as your safe place to store your savings, okay? So again, remember, your savings is where you want to put your cash away, where you want it to be safe, liquid, accessible. You want to have control over it. Of course, you want it to grow. But most importantly, you don't want there to be any risk to the principal, okay? That's really kind of the key differences between savings and investing. With investments, you're willing to take some level of risk for some level of return. You usually have to park that money away for some period of time, whether it's short time, like 90 days or a year, or a longer term investment might be, 5 years or 10 years. So an investment is really, where you're putting your money away for a period of time. It's usually inaccessible for that period, and you're kind of applying some level of risk. With savings, there's no risk. Principal is safe. Your money still grows, and it's still liquid, and you still have access to it. So that's the difference that I'm illustrating here. So if we refer to an alternate account, again, let's just say it's a savings account at your credit union. This is just to illustrate that it's showing what your money would grow to be if you had applied the 4.6% each year. So in this scenario, this would be the equivalent of putting in these dollar amounts each year into your bank account. You can see it growing at 4.6%. Here's what the annual interest rate is each year. If we scroll down to age 95, you'll see that it has grown to the same $7.4 million that we had here in the cash value. Okay. So you are probably looking at that and saying, well, then Lesley, if I could earn the same money in my savings account, why would I put it into a whole life policy? And my answer would be to you, number one, there are no savings accounts, no money market accounts, no CDs that I've seen or heard of at this time in 2019 that are offering those kinds of rates. Okay. So if anyone knows of one, please let me know. I would love to learn about it. Always want to offer clients great alternatives and great options. But as far as I can tell, most of those types of accounts your savings account might be offering 1%, maybe even 2%. And a CD might be earning 2.5%, or money market account might be earning 1.5%. So it's really, really unheard of at this point to find a savings type of account that's available offering a rate of 4.6% each year. Okay. So the second thing I would say to you is not only can you not find a savings account that's offering 4.6%, but any earnings on those savings is subject to income tax. So I'm going to be very generous here. I'm going to just say that perhaps you're in, let's just say the 28% tax bracket, but perhaps you live in a state where you pay state taxes. So let's just use a blended rate of 32%. Okay. So you're still seeing here, the deposits are going in each year. If we apply that same 4.6% annual rate, you still see the annual interest growing, but now you're seeing the taxes applied year over year over year. Okay. And you end up paying $1.3 million in taxes over that 60-year period. So instead of having $7.4 million at the end of it, you actually only have $3.9 million. A little bit more than half of what you would have had in the life insurance policy. Okay. If you listen to another previous episode on the podcast, I talked about the 5 major wealth destroyers, and we talked about taxes being one of them. And this is really to help illustrate that case. What this is also showing is that you would need to earn 6.77% each year for 60 years to get to the 7.4 million, or in other words, to match what you would have earned in the whole life policy. So again, you would have had to earn 6.77% each year for 60 years to match what you would have earned in the cash value account. Now, in addition to this, most people have heard what's considered to be advice, and I know it is offered as advice, but it really was, a tagline for a company in the 70s, and it's just become financial advice. But most people have heard to buy term and invest the rest. So what I want to do here is apply that scenario here to this person's case. Now, in this case, she has a 20-year term policy. So you can see, this is actually another good illustration here. Term life insurance is extremely affordable when you have it, whether it's a 10 or 20 or 30-year term, because typically it's issued to people in the years when they're least likely to die. Statistically speaking, the probability of them dying is very low. Therefore, the insurance companies are willing to offer you a low premium. But as you can see, at the end of the term, the premium, if you were to continue the policy, would skyrocket, okay? It would jump, in this case, from $920 to almost $16,000 the following year. And the reason for that is the insurance company would have to try to recover or recoup the cost of insurance that they weren't able to get during those first 20 years. In addition, simply because you're, approaching an age that has a higher probability of you dying, they're going to increase the premiums. So that's really just how term insurance works. But in this case, as most people, they're not going to renew their term insurance after the term when it has ended. So we're just going to adjust this to show that, let's see, at age 54, this policy runs out. And you can see how that looks in the end. So over the course of 60 years, you're still earning that interest, but you've paid almost $1.3 million in taxes. You've paid almost $19,000 in premiums, and your balance is at 3.8. So again, half of what you would have had in your cash value. And this also means that you actually would have had to earn 6.86% each year for 60 years to earn the equivalent that you would have had in the cash value account. So then the next thing people say to me is, well, obviously, I can't earn 6.86% in any type of savings account. So then at that point, they're considering brokerage or managed services, maybe with a financial advisor. Maybe this is where they're looking at an IRA or a 401k. They're looking at some type of investment, right? So now we're moving outside of the realm of savings where your principal is safe and there's low risk or no risk. So now you've got to consider investing, where you're assuming because you take on some risk that you're going to get a higher reward. So let's just say that at this point they, go work with a professional, a financial professional. And this advisor is going to charge them anywhere between 1% and maybe 2% of their assets under management. And that's just their fee to manage their money. This does not include transaction fees, expense ratios, administrative fees, and other fees that are ongoing, okay? So I'm always fully transparent. So I'm not saying that when you have a whole life insurance policy that there are no fees. What I'm saying is there are certainly some costs up front, but you do not have the ongoing fees, which is really what erodes your wealth over time. And the danger in a lot of times with managed accounts or other accounts where there's these ongoing fees is that you're typically not aware of what the fees are, or it's not itemized for you. So when you get your monthly or quarterly or annual statement, it is showing you the net of what you have. So it's after advisor fees and other transaction fees have come out, you're just seeing what's left over. You're not ever really able to see the gross, you only see the net. But in any case, I'm just going to use a conservative rate of 1.5% and apply it here. So again, you can see applying the same deposits and the same annual rate of return of 4.6%, you're seeing the interest that's earned. However, you now see that you would be paying, let's go to the bottom, you'll now see that you'll be paying $635,000 in taxes in total over 60 years, almost $19,000 in term insurance premium, and over $1 million in fees. Okay? Over $1 million in fees. So you net less than $2.5 million, so about a third of what you would have in a whole life insurance policy. And you would have had to earn almost 8.5% every year for 60 years to earn a third, to accumulate a third of what you would have had you been storing your money in a whole life policy. Okay. So I'm hoping that this helps to illustrate the concept that I was saying, that there is no better place to store your cash. So whether this is a scenario where maybe you're just coming out of school, or you're just coming out of a divorce, or you're coming out of some situation where you're just kind of starting from the beginning, starting from scratch, and you're building up your savings. Or maybe you are a business owner and you just need somewhere to put your capital. You need it to be, somewhere, again, secure, safe, not at risk to be lost, but you want it to grow. Maybe you're an investor and you have monthly cash flows or annual cash flows or some variable period of cash flows throughout the year. And you want to put that cash away. You want to put that money away somewhere safe, secure. You want it to build up so that you can then use it for the next investment. Or if you're a business owner, you want to use it for maybe expanding your business, maybe to purchase equipment, maybe to, cover costs when sales are low. I mean, it could be for any reason. From a personal finance standpoint, this is really what I call your life happens account. This is having money available for when life happens, whether it's planned events or unplanned, good or bad. You have money put away that you can access that's liquid, and you have full control. That is what you would get in a whole life insurance policy. Okay? So just for a cash on cash comparison, you can see here, so when you're initially, those first years, you're funding, you're building it up, right? You're funding this policy. So this is not a short-term, strategy. This is a long-term strategy. So in these initial years, what this is showing is that, yes, your alternate account, so let's again say it's your, brokerage account, it is going to have a higher balance than your cash value account in these initial years. That's why this is red. It's showing a negative. But starting in year 16, you're seeing how from that point on, you have considerably more money growing in your cash value account than you have in your alternate account. And this is where you're really seeing how the fees, the ongoing fees and the taxes are just eating away at your money. And in the end, after 60 years, had you been putting these funds away into, a brokerage account, you would have less than 2.5 million, but you would have almost 7.5 million in your cash value account of your whole life policy. It's almost a $5 million difference. Okay. So hopefully, again, that helps to illustrate why you would consider using a whole life insurance policy, of course, structured correctly with the right type of insurance company, where you would be able to earn those kinds of, annual equivalent of those types of annual returns. If you have more questions, or if you would like to see these numbers for yourself in your own scenario, and possibly have an illustration run for you, please don't hesitate to reach out. Again, my name is Lesley Batson, and you can find me at rebelrockwealth.com. Thank you so much.